Hello everybody and welcome to the Cyclical Investors Club channel. My name is Corey Kramer and today this video is going to be a bit of a tutorial video about how I adjust earnings growth rates for stock buybacks. This came in by request from a viewer a couple weeks ago, and I put it on my kind of to-do list. It took me a while to kind of come up with the best way and the easiest examples that I could share in order to kind of show how I do this. But first, I'll start off by saying my view of share buybacks is different than most investors' view of share buybacks. When I look at the earnings of a business, I really look at them from the perspective of an owner of the business. And I really want to know, and sometimes people can calculate like owners' earnings, and there's like ways to do that, but I kind of have my own quick way of doing like almost everything. So really what I want to do is put myself in the position of somebody who owned this whole business and was keeping the earnings and not reinvesting them back into the company. And then it really kind of levels the playing field for all different types of businesses. I do see some investors, when it comes to dividends, actually adding the dividends back into the growth rate of the company or the dividend growth rate. I think that is the wrong way to do it most of the time, because a lot of dividend investors want to be able to spend the dividends when they retire, right? Well, if you're spending the dividends, or even if you're taking them out and investing them in a different company, then you shouldn't assume that you'll get the benefit of that reinvestment when you're analyzing the valuation of that particular business. I view earnings, or I view buybacks exactly the same way as I view dividends. They come after the earnings. So if the company's doing something with that money after they earn it that affects the earnings per share, or anything else really, I don't really want to include that because it forms like a feedback loop over time. And we'll see that with AutoZone here. I am long AutoZone, so it's not like I'm making a judgment whether buybacks are good or bad. Usually, if a company buys back shares, it very much depends on how the future company does, whether those and how much they paid for the stock at the time, whether those buybacks were a good idea or not. So it's much more about rational capital allocation, what makes more sense. Can the company take those earnings and internally reinvest them, with R&D or expansion or whatever, acquisitions? Can they do that and have the returns that they get from that be worth it? Or is it better if maybe their growth prospects are kind of more full, if they just go ahead and return those profits to shareholders? If the stock price and the valuation are quite low, then dividends might be the best of those, or not dividends, but buybacks might be the best option. Or if the future prospects of the company are quite strong, buybacks might be the best option, because the owners of the company know that company better than anything they're going to go buy. And there are tax inefficiencies with dividends, and that's money that the company can't use for other things. They can't usually be as flexible in the United States. In other companies, just because of the shareholder base wants dividends. In other countries like Japan, there's much more rational capital allocation that amazingly, like, American investors seem to not like, because they aren't as aggressively propping up their stock prices usually, and the dividends can fluctuate. They might be a percentage of the earnings or something like that, or the free cash flow or whatever. So this isn't a judgment on buybacks per se. It's just they can influence the earnings growth rate that you might otherwise calculate if you don't take them into account if you're viewing it from the way that I am, is I really want to know how much this company can internally generate without not really including what they're like buybacks or dividends or whatever. So hopefully that people understand that. I don't know if I explained it well enough, but if you look at AutoZone stock, you can see, let's go back even longer on the fast graph here. So very smooth, very beautiful earnings chart. This dark green area is their earnings per share. Okay. So when you buy back stock, the earnings per share, the shares decrease. Okay. So that inflates the earnings per share. So these earnings per share, if there weren't any buybacks, would be quite different than when there are buybacks. And since the 2015, mid 2015, which is when I have this near-term chart, AutoZone has bought back about 43% of their shares outstanding. So they've been buying their own company back. They don't pay a dividend. Okay, so if they paid a dividend, that money, instead of going to buy shares, would be going out the door to shareholders. Okay. But they've chosen a different route to buy the stock back, and that can help create this very smooth earnings per share because there's always somebody there buying these shares, which is the company, as long as they're making money, right? But what it can do is inflate what the earnings growth rate would be over the earnings per share growth rate would be over time because those shares are going down. So if you look on the fast graph, they have a little calculator here that shows you the earnings growth rate over this time period. Let me actually, I think it runs to the end when you put so let me shorten this just a little bit. So this would be to the end of 2024 fiscal year. Okay, and this is what I'm going to measure and show you the difference. So here they basically do this by measuring from this point to the point where you have the time frame set on the fast graph. By the way, if you want a discount to fast graphs, there's a 25% off discount link down in the description. I get a little commission from that if you decide to join fast graphs, even though on this video I'm going to show you one of the corrections that I like to make, or just the information that isn't in the fast graph easily. And it has to do with these buybacks because that's something that I care about in my style of investing. Most other people don't seem to care about. So from this point up to 2024, that's a 9-year time period. They're going to measure what were earnings per share here and what were earnings per share here. And then that calculates out this earnings growth rate during that time, which is 17.19%, very fast earnings growth. But the shares outstanding have been reduced by about 43% during this time. Now, if they, as far as I know, that isn't easily available here on the at least on the basic version of the fast graphs that I have. So you can try to find like another site that maybe either another program or just another, maybe even a brokerage account might be able to quickly do it. But if you can't, you can go to the financial statements of the company, and it won't take too long because you can start in this year and look how many shares outstanding there were, and then go to the current time and look how many shares outstanding there were, and you can see what percentage it was reduced by if they're buying back shares. And so you really only need to look at two points on two financial statements, and boom, you got your number, and do like one math problem and you got your number. So it's not really a hard thing to just look up by yourself. Once you get to the stage where you're kind of have a short list and you're like, okay, this earnings rate seems really fast and really smooth and they never seem to have any problems, like that might cue you up to say, let's go see if share buybacks are like contributing to some of this. Another couple big companies that buy back a lot of shares like this are Home Depot and Lowe's. They're pretty similar. Usually buybacks are a lot less than this, but I tried to pick one that had a lot of buybacks, and I didn't want to be too negative on it. I mean, since I'm long this stock and I bought it during the pandemic or whatever, it's been great. And they've managed to grow earnings despite the buybacks. So at any rate, what we want to do is calculate this earnings growth rate, and I use an earnings growth rate CAGR basically. instead of point to point. So usually it's just a little bit lower for that reason. So the way I do it is after I know how many shares, what percentage of shares have been reduced by over this time period, I basically imagine that this is just like, or pretty close to what I do to calculate my my CAGR, my earnings CAGR when I do a 10-year earnings CAGR analysis. I imagine that I have $100 that I own the company, and I calculate in each year's change in earnings growth. These are all positive. Sometimes they can be negative. What effect it has on that $100. Okay. So, for example, I start with $100 this first year. The percent change in earnings per share growth is right here. That is 13%. So after year one, I would have $113. Okay. Then I would take my $113. I'd look at what the growth was the next year. It's 8%. So I'd multiply whatever 8% to that $113. Okay. After you do, like, I want to say 1 million. I haven't done 1 million yet. But after you do tens of thousands of these little mini calculations, you get very fast at it. I just use a hand calculator, and I just boom, 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 boom. And then I get to the end, and then I see what my $100 would have turned into, okay? And in this case, over this particular time period, I did this pretty fast, but I have my $100 would have turned into $414, all right? The initial $100 was mine, so... And then I say, okay, I have that $414, but the share count was reduced by 43% during that time. So I just reduced that 414 by 43%. So you multiply it times 0.57 in this example. Now, this isn't a precise number because we don't know what price they paid for the shares. Usually, even sometimes I'll give you an average price in like the quarterly reports or whatever, but I'm not going back and looking up what would it be. This is 9 years for 36 reports, and then you can do all that, or I can do this in probably less than 2 minutes and get pretty close, because you're going to be a little farther away. Probably it's a little more punishing to the stocks, to the companies that are buying back a lot of stock, like an AutoZone or a Lowe's or Home Depot. And it will be more punishing the longer term time frame that you use. So if you start using like a 15-year time frame, you might want to put an asterisk next to the earnings growth. It's probably a little bit better than what you're going to roughly calculate using this method. So we started with 100. We would have had 414, but we took into account those share buybacks. So then it would have grown to $236. So I just go to a CAGR calculator. This one's free on MoneyChimp. You can just Google like CAGR calculator. You start with $100. You end with $236 over the course of 9 years. You hit calculate. It gives you the CAGR. This one is almost exactly 10%. I think the last time I calculated it, it was 9.91%. So it looks right. It's probably pretty consistent to whenever I did it last, a couple months ago. But the important thing is you can see the difference here. So now you have, if you don't include the buybacks or you try to adjust for them a little bit, you have a 10% earnings growth rate. And if you don't do that, you have a 17%. I mean, this is like a huge, huge difference when it comes to valuation. And I picked one that would have a huge difference. Normally it's much smaller, but it really makes a difference in these cases, because if you take a 17% earnings growth rate and you apply it to this 19 current or blended PE ratio that FastGraphs has, that's almost a buy right here. So it can look really attractive, and it's only kind of attractive. I mean, it's fairly valued. It's not overvalued even when you make the adjustment. Well, you can just think about it. So if you think of a PEG ratio, so we'll call this like a little under a 20 PE. You have a 10% growth rate. That's a PEG of 1.9, we'll say. That's like fair value. I mean, that's like pretty fairly valued compared to most, the kind of standard PEG ratio thing, where a 1 would be like a good deal and a 3 might be think about selling. You're right in the middle of that. So it's a big difference between being a buy and being a hold in some of the cases like this. And so hopefully that helps everybody when they're trying to calculate their own adjustments for the buybacks. If my kind of style of treatment of buybacks sounds appealing, it really just makes everything more conservative too. So I like to add in little margins of safety in little areas that kind of add up to like a bigger margin of safety because there's always going to be something you miss, and I like to do things pretty quickly. And this is one way that I can do it pretty quickly. So usually it takes me like, I would run this calculation in less than 2 or 3 minutes usually. A lot of it goes into the judgment also of the time frame that you choose. You want to pick a time frame that's rational. Generally, you want to always have a recession. That gets more difficult because we haven't really had a great recession, like a normal recession, since 2008. And then businesses have changed since 2008. So that 2015 time period is usually where I just kind of start. And then if they had like a giant growth year or something that just looks weird, I might make adjustments for that, as I go along. Same thing with COVID. I could make adjustments for that if I wanted to, if they were really out of whack. They're definitely high here, but they're not totally out of whack when you consider inflation and everything. So all those judgments are going to go into what your earnings growth rate comes out to. And the more rational you can be, and in some senses conservative you can be, during that whole process of picking all these little things, on a stock like AutoZone, it can make a big difference because the buy price can be very different, depending on what all these little decisions that you're making are. All right, hopefully everybody found this useful. If I ever find a faster way to do this, I'll definitely share it, but it can be useful to do a little handwork with the calculator yourself, because when you go through a lot of stocks, you'll start to notice patterns. And if you start making a mistake or two, which everybody does, you can go back and you can, when you have kind of a system that you're using, you can say, okay, why didn't this work? And it just gives you a better parameter to assess kind of what really happened. It's not always the narrative that's on TV or whatever. Sometimes it's things. There are a lot of things that are obvious to me that are not obvious to a lot of other people, just because I've done this so many times and I've made mistakes, and really being able to go back and it's better if you can analyze other people's mistakes, but if I can go back and look at my mistakes, say, look, is this something I really could have prevented? Sometimes it is, sometimes it isn't. A lot of times I know something that I'm buying is kind of marginal or a little riskier or a little more unknown. And if that doesn't work out, well, it was a borderline case anyway, so that's what happens sometimes. So that's usually nowadays, because I've done this enough, what happens. And then usually the other stuff could be really fluky things that you can't really quickly adjust for. Okay, if you found this useful, again, the Fast Graphs discount code's down below. Subscribe to the channel. I do a lot of individual stock analysis. I think I actually do have one up there on AutoZone if you want to see me go through this one specifically. And if you have any requests, put them in the comment section and I will get them on this whiteboard behind me. And when I'm not making the occasional tutorial video, I will do the individual stock analysis. All right, thanks a lot, everybody. See you later.